Mint is still $15 a month for premium wireless. And if you haven't made the switch yet, here are 15 reasons why you should. 1, it's $15 a month. 2, seriously, it's $15 a month. 3, no big contracts. 4, I use it. 5, my mom uses it. Are you playing me off? That's what's happening, right? Okay, give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan. $15 per month equivalent required. New customer offer first 3 months only. Then full price plan options available. Taxes and fees extra. See mintmobile.com.
Reality radio for a really great future. We're talking real money.
Yeah. Look, it's a Friday. I think it's a Friday. I'm pretty sure it's a Friday. If I sound a little echoey, it's because I'm recording this Friday edition of the Talking Real Money podcast from a hotel room in Asheville, North Carolina, which was where I had to record it based on my schedule. So we're going to be doing the thing we do every Friday, and that is taking your questions that were sent in at talkingrealmoney.com on the contact form that you recorded and spoke, and then answering them on the podcast, which is one of my favorite podcasts. So send those questions in, talkingrealmoney.com. Also, remember, every Saturday you can call us on the radio when we talk about money on our program at 855-935-TALK, 855-935-8255. Do that on Saturdays at 3 p.m. Eastern Time. But most of the questions just send in through talkingrealmoney.com. You can type them. Can't tell you for sure when we're going to answer those, or if you speak them, I'm pretty confident those are going to get answered on a Friday in the next few weeks. So let's get to our first one for today, which is, well, look, there it is right there.
Hi, Tom and Don. I really enjoy your podcast. Your wisdom has helped me be prepared for my retirement, which I recently pulled the trigger on in my late 50s. I'm comfortable with my retirement plan as I have good control of my spending, and I built what I think is a comfortable safety factor into my projections of inflation and investment growth. I'm also quite analytical and enjoy tracking my spending and investments annually, which brings me to my question. What is your preferred method for calculating the annual return on an investment account, knowing the purpose is for tracking against a retirement plan projection and doing some comparisons to indices and benchmarks? I like to do this in an individual account, as I have a variety of accounts, traditional and Roth IRAs, brokerage, and HSAs, each with different investment portfolios to take advantage of their tax benefits. Some of these accounts will not see any new deposits or withdrawals for quite some time, so their return is simply the growth or loss of the investments in the period. Some of the accounts have management and custodial fees, which I tend to just lump into investment gain and loss. And some accounts still have active deposits and or withdrawals during the period. For me, simplicity is key, but I do want to consider the impact of cash flow in and out of the accounts. One would think this would be a simple math question, but I have found it is more complicated than that with many different approaches. I'm not trying to say compare one investment over another, which might require a more complicated approach. Rather, I want to use this to track against my projections and guide any adjustments to my plan. What would you recommend? Thank you in advance, and thank you for the great information and experience you share with your listeners.
Well, as one who really has a spreadsheet mental block, and I do, I have a terrible spreadsheet mental block. What I think you're looking for is the dollar-weighted return, because you mentioned money going in, money coming out, and then the value of the portfolio. And there is a function in spreadsheets that accomplishes this, and it's called XIRR. I believe that's it. So you put in your deposits, your withdrawals, and then your ending value using that function. That will give you your dollar-weighted return. What most of us do is just the time-weighted return, which is where we look at what it's worth at the beginning of the year, what it's worth at the end of the year, if you're reinvesting dividends, and that's your return. If you're not reinvesting dividends, then you have to add those dividends in. But I think that's what you're looking for is a dollar-weighted return, and you would do that in a spreadsheet. If you want the math, sorry, I'm no math professor, but I do it in a spreadsheet. Thanks so much for your question. We appreciate it. And remember, you can call us every Saturday at 855-935-TALK, starting at 3 p.m. Eastern Time, or you can send your questions in at talkingrealmoney.com. Just hit that button that says Contact Us, and we'll get those answered for you. Let's go to the next one.
Hello, Don and Tom. This is Jill from Coeur d'Alene. As always, thank you for everything that you do, your podcast, and answering all of my questions. And I have another question. You guys talk about a 3-part portfolio, and I'm in the process of transferring my money from CDs into a brokerage account. I'm feeling like I'm ready to take that risk. I've accumulated a lot of money. And I'm thinking of putting 50%. I have a Vanguard account, so I'm thinking of putting 50% of my money in VTI, 20% in VT, and then 30% in BND. I have about $200,000 that I'm going to be putting in this brokerage account as my CDs mature, and then I'll be slowly putting it over. I just wanted to hear your analysis of those choices. And again, thank you for all that you do.
Well, I think the portfolio allocation you're going for right now is way, way, way too overweighted in the U.S. If that's the right stock bond allocation for you, I'm good with that. That you determine by your risk needs and your risk tolerance. So it's not the bond stock ratio that concerns me, but it is the U.S. to international ratio. For a very simple portfolio, you probably ought to just consider VT and BND instead of adding in VTI, because VTI overweights you to the United States. So it's the U.S. the VTI is the U.S. index. VT is the global index, which gets you the entire global market. And that's what we want you to own, particularly if you're just getting started right now as an investor. We don't predict the future, but the U.S. market has done extraordinarily well over the past several years. The international market's not as well until recently, and you could be just hugely disappointed, being heavily in the U.S. when we eventually, someday, could be years from now, could be tomorrow, get a big downturn here. So I would rather see you have a better U.S. international balance, and you can accomplish that and get it rebalanced for you by Vanguard, which makes your life a lot easier, by just using VT as your equity portion. So I would skip VTI completely. Thanks for your question. Here's our next one.
Hi, Tom and Don. My wife and I have 2 kids, ages 6 and 8. And when they were born, my father-in-law opened up a custodial UTMA account, one for each of them, which was great. The problem is that my wife and I are no longer on speaking terms with my father-in-law. So my question is, can I open up a separate custodial account for my kids, or are they only allowed to have one each?
Well, I'm sorry about the rift in the family, but you can have your kids can have as many custodial accounts as people want to establish for them. So you could set up your own, any other family members can set them up. But if you don't have one yet, instead of a UTMA or a UGMA, Uniform Trust to Minors, Uniform Gift to Minors, or Uniform Transfer to Minors, Uniform Gift to Minors, look at a 529, because you have the benefit of some control in a 529, which you don't in custodial accounts, because they become the property of the child at the age of majority. You don't have any say in where the money goes when they reach 18 or 21. Whereas in a 529, you do. And the other really great advantage of a 529, if you hold them long enough and the kids don't decide to use all the money for school, then they can use that to help fund their Roth IRA in the future. And that money's just tax-free basically forever. So I'd look at a 529, but yes, you can have multiple UTMA accounts. And I hope you get back on speaking terms with the in-laws. Thanks so much for your question. And remember, again, questions are taken on our website at talkingrealmoney.com. Hit that thing that says contact us in the upper right. Or on Saturdays, if you want a conversation. A lot of people are doing this now, and we love it. Call us on Saturday, 3 p.m. to 5 p.m. Eastern Time at 855-935-TALK. That's when we do our radio show that becomes a podcast the next week. And let's see. This is question 4.
Hi, guys. I love your show. Hey, I'm trying to decide between AVGE and VT, and it seems like you guys push the Avantis funds quite a bit, but AVGE has an expense ratio of 0.23% versus VT 0.06. And I know AVGE hadn't been around as long as VT, but when I compare the performance of both these ETFs, it seems like VT consistently beats it. So I was just wondering if you guys have a preference of AVGE versus VT. Are you indifferent? And if you're indifferent, why wouldn't you just pick VT since it has a lower expense ratio? Thanks a lot.
Well, we're not indifferent. And I know it sounds counterintuitive that we prefer AVGE to VT. One, it has that higher expense ratio, but it's still down in the dirt cheap category. And the reason it has a higher expense ratio is because it is a fund that is more difficult to run. VT is so simple. They merely buy the index of all stocks on the planet. AVGE has all manner of screens that hoops that stocks have to jump through. And so it makes it a slightly more expensive process. And your tense is where you're getting tripped up. You said VT is doing better. It's trouncing it. Well, no, VT has trounced it. Has. That's why we don't like comparing just returns, because it's not a fair comparison. The reason we like AVGE so much is because AVGE gives you something that academic, really robust, 100-year almost academic research says it, over a long period of time, should increase your returns. So it's a riskier fund. AVGE is a riskier fund than the Vanguard Total Market. AVGE is the Avantis Total Market Fund. But again, they overemphasize smaller companies and they overemphasize value stocks. Now, those two areas over the past decade have done pretty badly, whereas large company U.S. growth stocks have done incredibly well, thus the performance difference. That's the reason. However, historically, and when you think about this logically, it makes sense. That's why we actually try to apply logic to the process, not just looking at the numbers, but what makes sense. Does it make more sense that over time, smaller companies have more room to grow and would make more money over long periods of time than large companies? The fact is, over 100 years, not only have they made more, they have made dramatically more. Huge differences between big companies and small. Does it not also make sense that those companies that are currently having some trouble, that are undervalued, value stocks, would over long periods of time do better than growth-oriented stocks that are relying on earnings growth? In a very good economy, growth-oriented stocks do really well. In a softer economy, value tends to do a little bit better. And over long periods, multi-decade periods of time, again, the peer-reviewed academic research supports the belief that small and value is likely to make you more money over time. That's why we prefer a fund like AVGE, and we put our money where our mouths are. I'm in AVGE and DFAW because I want that small value tilt, even though I've made less money. And there is great research to back it up. So that's what we do, and we don't do it because we're getting anything in return. I can absolutely guarantee you that we have no financial ties to Avantis or dimensional funds whatsoever. We don't get paid anything by Vanguard. We probably recommend Vanguard more, and we get nothing from them. We don't get anything from anybody. This is what we believe works for various reasons. And again, we suggest VT all the time. We just believe if you really want to maximize your 30, 40, 50-year returns, that you're likely, at least you would have in the past, you would have done better in the past if you had overweighted value in small. You're still going to own large and growth. You're just going to overweight the other. So that's why we do what we do, and it's because they're more expensive portfolios. If Vanguard did a tilt towards small in value, it would be a more expensive portfolio, particularly with the screens that Avantis and DFA use. Thanks for your question, and remember, again, call us on Saturdays if you want to talk to us live, 855-935-TALK, starting at 3 p.m., or you can just send your questions in, type them, or speak them anytime at talkingrealmoney.com. And here's today's final question.
Hey, Don, quick question for you. I've been listening to a guy named Frank Vasquez, Risk Parity Radio, and he talks about different portfolios for accumulation versus decumulation. He's very confident in what he talks about with his decumulation portfolios, and he has managed futures, gold, intermediate and long-term treasuries, growth, large cap growth, and small cap value, I think, is kind of the bulk of most of his ideas. And he claims you can get a higher safe withdrawal rate by following that portfolio, and that you get like 5.5% safe withdrawal rate with using that because it's more recession proof. And I just have a hard time kind of accepting his way of thinking, but I also can tell he's very well read, has studied this very carefully, and just wanted to hear your thoughts on him, and maybe if you've listened to his podcast before, and kind of chime in on your opinion. Thank you very much.
Frank Vasquez has not come up in a long time, but he has come up in the past. And we have listened, and we have read, and we have looked at the numbers and run some calculations. And his is just an extreme variation on the diversification theme. We like the diversification theme. We just don't like how far he's taking it. And I'll explain. One of the things is this golden ratio stuff. That almost, I think it's gamification of the process. You don't need a golden ratio. It's not, a ratio is not going to change the way a portfolio performs. But what he does really is he tries to reduce portfolio volatility by adding commodities and gold. Gold is a commodity. It's just the classic commodity. We don't, because we don't want asset classes in the portfolio that have zero expectation of adding value. Why do we need to reduce the volatility further than we reduce it with bonds? And in the past, we've laid his performance, he reports his performance, up against the performance of a balanced index, like Vanguard's balanced index, a 60-40 portfolio. And the thing that you find is exactly what you would expect to find. You expect to find reduced volatility because the commodities tend not to move as much, although they can be very volatile at times. They just tend to zag when the market's zigging. But the overall impact is you would have reduced your volatility in the past, but you would have also reduced your return. And it's a trade-off. And it's more complicated, and it's more expensive to put into practice, generally speaking, and it's harder work. We're big fans of keeping it simple, and we just don't think you need to go this far. We've looked at the numbers, adding commodities. We've talked to the folks at Dimensional and Avantis and Larry Swedroe and all kinds of economists about the value of adding commodities. But for the stuff we do here on the radio, we don't believe you should have to do that, or on podcasts. We don't believe you need to do that much work, because what it's going to add isn't much, and it's going to take away simplicity, and we're big fans of keeping it simple. So there you have it. Yes, we have looked at Frank in the past. We wouldn't follow his advice to the letter, but it's kind of similar to what we talk about without the hocus pocus. the golden ratio. Anyway, thanks so much for all the great questions. I really do appreciate them, and I apologize for the echo. I'll be back in the studio for the next one. And if you want to ask us questions, just go to talkingrealmoney.com and click the contact button. If you'd like to sit down with one of our Appella advisors, we've been offering this since they were our Vestry advisors, and just get a little help. Sometimes you're a do-it-yourselfer, but it's like, oh, I really like to have somebody look at my portfolio and see if I'm doing this right. Just go to talkingrealmoney.com, click the button that says Meet an Advisor, and here's what I can promise. You will get some help. You will not get someone who will manage your portfolio for you for free. That is a terrible business model. You will not be asked for any money. You will not be subjected to a high-pressure sales pitch to become an Appella client. We don't need to do that. We're doing fine, thanks. If you want to become one, that would be great. We would welcome you with open arms and help you do the best you possibly can. But nope, no obligation. Thanks for being there. Tell your friends about the podcast and join us pretty much every day and Fridays for Q&A as we're talking real money.